following the worst year for equity markets since the financial crisis. 2019 turned out to be one of the best, with most markets producing substantial double-digit returns. Unusually, nearly all asset classes performed well, as many of the risks overhanging markets as we entered 2019 failed to materialise. The US-China trade wars moved towards a phase 1 deal. The UK did not fall over the Brexit cliff edge. The world economy slowed but didn't enter recession. China's debt bubble was contained. In geopolitics, caused ripples but no serious dislocation. Most important of all, however, was the policy pivot by the Fed, which moved from an overly restrictive stance as 2018 progressed to a much looser policy, with other central banks, notably the ECB and the People's Bank of China, moving in the same direction. Investors could not have wished for more. But in a year when corporate earnings were broadly flat, returns were 28% from developed market equities and 18% from emerging markets, leave valuations materially higher than a year ago. Strong returns from bond markets, US Treasuries 7%, corporate and high yield bonds 14%, push yields and credit spreads to historic lows. The question then is whether the bull market, now the longest in history, can continue and what might derail the benign conditions of the past year. The market gains in 2019 need to be kept in perspective. Most markets remain below the levels reached in early 2018. The main exception is Wall Street, which has continued to lead global markets. It's now some 10% higher than 2 years ago. But over that period, corporate earnings are also higher by some 20%, leaving valuations lower today and not stretched by historic comparisons, especially taking into account the low inflation and interest rate environment prevailing throughout the post-crisis decade. It's highly unlikely that the big dovish policy pivots by the key central banks that drove markets in 2019 will be repeated in 2020. Equally, however, there's no realistic prospect of a reversal of policy anytime soon. After the loosening of the past year, Fed policy remains on hold, but with a dovish leaning, and with both growth and inflation at subdued levels, there seems little likelihood of tightening in 2020. In the case of the other big central banks, the ECB, Bank of Japan, Bank of England and the People's Bank of China, policy tightening remains a distant prospect. The Eurozone and Japan are mired in a structural low-growth, deflationary environment. The UK is yet to emerge from 3 years of intense economic uncertainty, which has held back confidence, investment and growth, while China's growth continued to slow inexorably in the face of high corporate debt, demographic headwinds and the impact of trade wars. Indeed, the PBOC's first move in 2020 has been to loosen policy further with another cut in reserve requirements, injecting more liquidity into the system. Loose monetary policy globally is set to continue for a long time ahead and will provide support for economies and markets. While global trade and manufacturing suffered a sharp recession in the past 12 months, there's been limited spillover into the key consumer and service sectors. Economies have slowed but not stalled, and employment has remained generally strong, with real wages rising modestly. Recent data is showing some stabilisation in the manufacturing sector, which has been held back by trade wars and weak confidence. The Phase 1 trade deal now agreed between the US and China augurs well for some improvement in confidence as 2020 progresses. The recession widely predicted has not arrived, and conditions suggest a continuation of modest but sustainable growth ahead. The removal of the market's worst fears about trade wars and Brexit reduce risks and will help to restore business confidence and investment. Trump's unpredictability means that trade war risks have not been eliminated, but evidence shows that deals will ultimately get done, and this is likely to be even more so during an election year. With Brexit, the UK will be out of the EU at the end of January and in a transition period ending on the 31st of December 2020. A date that Prime Minister Johnson has now set in law. There'll no doubt be concerns about a so-called no-deal or cliff-edge Brexit if a new trade deal between the EU and the UK can't be agreed by then, but these are misguided. The trade negotiations start from a position where the UK and EU already have a deal in place, and many side deals on parts of the future relationship have already been agreed. Only politics could hold back some sort of deal by year end. Even in the worst outcome, leaving the EU on WTO trade terms, the UK is much better prepared after over 3 years of preparations. The most likely outcome is that at the very least a partial deal will be concluded in time, thereby finally removing Brexit uncertainty. With the prospect of a hard left government also firmly dispatched, and with a government that has a clear mandate and now the most powerful leader in Europe, with the vision to grasp Brexit as an opportunity rather than a disaster, the prospects for the UK are very much brighter than for several years. With growing recognition that monetary policy has limited room to provide further meaningful stimulus, especially in Europe and Japan, there's rising pressure and political appetite for fiscal expansion. It's clear that the new UK government will provide a fiscal boost with increased infrastructure spending over the next several years and an immediate easing of tight public sector spending restraints. With interest rates at or close to all-time lows, the pressure to spend, funded at negative real rates across most of the developed world, will be hard to resist. And even fiscally ultra-cautious Germany is moving slowly in this direction. An election year in the US is likely to encourage some fiscal stimulus, and Japan has already announced a sizable package to support growth there. Reduced risks, the positive effects of 2019's monetary easing, and the likelihood of some fiscal stimulus suggest that the worst of the global growth pause could well be behind us, and 2020 offers the prospect of somewhat improved conditions. With inflation and inflation expectations remaining benign, this provides for a better, albeit still challenging, backdrop for the corporate sector. But as ever, risks remain for investors. While unemployment is low across much of the developed world, any pickup in growth, and particularly a significant shift to fiscal policy to stimulate growth, could result in higher real wages, in turn pushing inflation higher. That's not currently built into inflation expectations, which remain anchored well below 2% in the US and lower elsewhere. While this seems a low risk at present, such a scenario could result in much earlier monetary tightening than is currently priced in, and would have a high impact on markets, especially bonds, which are trading close to all-time low yields. The US presidential election is now in sight, and uncertainty could be raised, especially if the Democrats select a left-wing candidate who would roll back some of Trump's business-friendly policies of tax cuts and deregulation. At this early stage, a second Trump term seems the most likely outcome, and while this suggests continuity, it also means continuity of unpredictability. That unpredictability means setbacks in the trade wars can't be dismissed. It seems unlikely that Trump would choose to escalate risks of economic disruption in an election year, but nothing can be ruled out. Evidence of the president's appetite for risk in his foreign policy has been starkly illustrated in the early days of the new year, with a dramatic escalation in the long-running dispute with Iran. While this event alone is unlikely to derail the global economy and markets, it represents a material deterioration in the relationship between the US and Iran, which, if it were to continue, could further destabilise the already unstable Middle East, and has the potential of delivering a short-term oil supply shock. While the world is much less dependent on Middle East oil than in previous periods of disruption, and the impact of a shock would be much more muted, it nevertheless would be a particularly unwelcome development and could undermine markets. Finally, debt remains a headwind to growth and stability. Debt levels in aggregate are higher today than before the financial crisis. While there are no signs of liquidity shortages, banks are well capitalised today compared with a decade ago, and ultra-low interest rates make debt more affordable than in any previous cycle. High debt provides a constraint to growth and would become a problem in the event of a turn in the interest rate cycle. While this is a distant prospect currently, there are pockets of concern, most notably in China. Here, corporate defaults, previously unheard of, have picked up significantly in the past year. China has the wherewithal to contain the problem, but given the critical importance of China to the global economy, any mishaps have potentially far-reaching implications. Balancing these risks against the broadly favourable economic and monetary backdrop, we expect markets to make further progress this year. However, the starting point is very different to that of a year ago. Valuations are materially higher in both equity and bond markets, and return expectations must therefore be more muted. We see the best opportunities again in equities, and with the prospect of some stabilisation in the manufacturing sector and a pickup in business investment, undervalued cyclical and value stocks could well stage a recovery after their sustained underperformance against growth stocks over the post-crisis decade. In bonds, emerging market debt offers the best value in an asset class which is relatively expensive, but which, in the form of US Treasuries, offers the ultimate safe haven protection. Arguably the best protection is offered by US inflation-protected bonds, which provide both the certainty of US Treasury backing as well as insulation from any pickup in inflation as the cycle matures. As ever, we believe that diversification remains the cornerstone of successful long-term investment, and we will continue to blend a core exposure to global equities with selected infrastructure and property investments, along with non-correlated assets, including US Treasuries, specialist alternative fixed income assets, and liquid alternatives, plus gold, which continues to act as a reliable diversifier and safe haven. With true diversification and tactical exploitation of the inevitable setbacks which will come along, we believe that mid to high single-digit returns are achievable in the year ahead.